In June 2024, Fidelity Bank issued shares to the public just in a bid to meet up with CBN recapitalization exercise. And last year, the share price was selling for 9 naira. So let me show you something right here on my charts. Fidelity Bank, June last year. So this was it, 9 naira. So between June, July. So I received a lot of questions from portfolio members and even non-members, like whether Fidelity Bank was a buy at that period, whether 9 to 10 naira was actually a good buy because the share price, the market price was a bit higher. I think around 10 naira when the share was going for like 9 naira. So because of that, I had to post a YouTube video just to share detailed analysis of Fidelity Bank. And then interestingly, the share was oversubscribed according to what business they posted here. You can see Fidelity Bank public offer oversubscribed by 237%, sorry. And then if you look at the share price that period, you can see here Fidelity Bank has issued the result of its recent offer for subscription of 10 billion ordinary shares at 9 naira 75 kobo. 75 kobo. So the share price was 9 naira 75 kobo. I think market price was like 10 naira or so. So the question is, where is Fidelity Bank today? Fidelity Bank is actually selling for 20 naira. That's almost 100% return. So if you key into Fidelity Bank public offer at 9 naira 75 kobo today, it should be on 100% return from that period between June, July, last year till date. That's almost like one year plus. Now, the question again is, how can I find stocks like this that would give me this kind of return? Now, I didn't know that Fidelity would do 100%, but from my analysis, I was very sure that the stock was grossly undervalued. And one of the major line items I looked at when I was analyzing Fidelity Bank statements, and you will see that on my YouTube channel, was the customer confidence. You know, a lot of people just jump into banking stocks thinking that, oh, they are banks. Okay, let's look at definition of a bank in a layman's way. A bank accepts deposits, right? And then they give out loan. So meaning that the moment a bank stop accepting deposits, that is the beginning of that bank's end. Now, how does it accept deposits? They don't come to you to force you to collect their money. They come to you to persuade you, meaning if you are convinced enough, you will go to the bank to deposit. So deposit is actually a way to look at what I call customer confidence. So when I was analyzing Fidelity Bank last year, the first thing I looked at was customer confidence. Are customers' confidence in Fidelity Bank improving or declining? Like you can see right here, I said customer confidence in the bank says a lot about the bank's ability to sustain low-cost funds. A bank that raises more funds via customer deposits will generate more return than a bank that uses debt. There are two ways bank generates money. I'll talk about that, either via customer deposits or debt. So I look at average growth of customer deposits in the last 5 years. So I like to see a bank generate more funds via customer deposits than debt because debt is very, very expensive. Today, we are going to be looking at another bank. This bank is surprisingly undervalued. I actually see this bank as being underrated. Like when you talk about top banks in Nigeria, I'm not sure it's among the first three or first four people want to mention. Where, as we already know, the first thing is here is Zenith, GTB, you hear Access, but this bank doesn't really come among the first top three or top four. But when I took my time to break down the data, I was quite surprised. Like, wow, this bank is grossly and surprisingly undervalued. So that's why I decided to bring it to you guys, my YouTube guys. Like, if you are looking at long-term investment in the banking space and you're looking for a bank that you think is still undervalued, bank you can hold on to for the next 3 to 5 years based on certain trends, then this might be the bank to watch out for. So before I continue, let me share my usual disclaimer. The ideas shared in this video are based on my personal research and calculations. Kindly do your due diligence before you invest in this company stock. Please note that the stock market comes with a lot of risk due to uncertainties, and also make sure you vet my recommendation based on your risk profile. And if you're not following portfolio today, you might be missing out a lot. Why go to different pages of newspaper when you can find all the headline on one page? So go to globfolio.com/today. It will show you all the headline across different newspaper. So globfolio.com/today. Like right now, I can go here. You can see it giving me headline. Most importantly, business headline across paper. You see from Business Day to this day to Nairametrics to The Nation. So you see a lot of headline that makes a lot of sense. Headline that moves your money. So you have them right here on Globfolio, and it's updated real time every hour. Every hour, it runs a check across Nigerian newspaper platform. And then if you find any good and interesting business headline, it comes here. So I intentionally limited it to business and market news because that's what I'm interested in this particular part of the world. So here, let's start. I usually say that banking stocks are great for dividend investors who want stability and cash flow. Yes, if you are looking for stability, like you want to put your money in a company that you believe is quite stable and would most likely give you pay out cash dividend over a long period of time. I think banking stocks are where you find one of them. Now, banks are tightly regulated by CBN, which makes investing in them subject to regulatory risk or certainties. Now, while this might look like a risk because today we don't know the headline, we don't know the circular that might come out from CBN tomorrow, we don't know, next week we don't know. But over time, I think that the way the banks are being controlled, where it's actually for your own good, especially as a depositor at the bank. But then when you look at it from the other angle, when I ran my research, I found that majority of top gainers in the Nigerian stock market, most of them you hardly see banking stocks. Most of the top gainers for the year in the market are usually non-banking stocks. You see, consumer goods stocks are always there. Consumer goods stocks, industrial stocks, oil and gas stocks. The banking stocks really come to that level, that top, where you see top stocks for the year, and then you see banking stocks are number one. It's very rare. It doesn't happen regularly. Yes, I also think that appreciation in the banking stocks are usually limited. It always comes during season when there's a major policy like we're seeing right now. So the question is, are banks going to do another 200 or 300% in the next 2 to 3 years? Well, that depends on policy and all that. But then I still feel that there are banks that are well positioned. There are banks that are still grossly undervalued today. And if you take advantage of the things I'm going to share with you right now, just like I did on Fidelity. Fidelity was selling for 7-9 naira when I posted analysis, and I told them Fidelity was grossly undervalued, that Fidelity should not be trading for anything below 14 naira. And today the bank has stopped 20 naira because as they release more, that was based on the information I had there, and the bank has released more information to us that probably make the fair value go higher. So today, I'll be looking at FCMB as one bank to pay attention to. But let's continue. So I say banks are tightly regulated by CBN, which makes investing in them very risky. But then, if you are considering investing in the banking stocks, I highly recommend banks that have historically. Now, look at this part. I highly recommend banks that have historically enjoyed customer confidence over the years and leveraged on them to deliver long-term value to shareholders. The single reason I recommended Fidelity Bank, and I was confident that Fidelity Bank stock was undervalued, and I knew Fidelity Bank would go up, was because of customer confidence. This is the starting point of every investment in the banking sector. So if you usually start your investment in the banking sector by always looking at the profit after tax, capital adequacy, blah, 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 you are missing the wrong thing. The first and most basic metric to watch out for when you are investing in the banking sector is customer confidence. I'm sure you've heard of bank rush. If today we all decide to walk into one of the banks today to withdraw at the same time, that bank will crash. no bank has ever survived bank rush, because that is where they generate most. That's what they use to run their operation. That's what they use to give loan to customer. That's what they use to invest in any other assets. So when we go to the bank to say we want to withdraw our money now, that bank is going down immediately. That's what we call bank rush. And I don't think that's what you want to solve. SVB that collapsed in the US, bank rush. So if a bank is to survive, then we need to look at our confidence in that bank. So if customers' confidence in that bank is very high, which I will show you how to do, then you are actually investing in the right bank. Then you can be safe to say that yes, your money is actually kept in a good place. So let me continue. So customer confidence is very key. So if I'm going to be looking at any bank today, that's the first thing. And then you're going to see interesting data, how I pulled major data from their financial statement from 2021 into 2024 and some into halfway 2025 using trailing 12 months. So I use the information that is available to me, especially from the Nigerian Stock Exchange website. So every data that I'm going to share with you, I pull them from the bank statement on the bank financial statement from Nigerian Stock Exchange website. So let's look at certain things. So in this video, I want to show you one underrated bank that is grossly undervalued. Why? Based on impressive compound annual growth in customer confidence, meaning that year on year, customer confidence in that bank is growing. So, and if customer confidence of a bank is growing, naturally it leads to what I call low single-digit cost of fund. Because when confidence in a bank is growing, people will naturally flock to that bank to deposit funds. It's simple. See, if any news like this breaks out today that bank A is having an issue, go and withdraw your money. Check out, you see what, especially when it comes to a reputable and reliable media platform. Especially let's see Business Day. Oh, I think XYZ Bank, I'm not going to mention name, just to avoid assuming or to avoid painting that bank as if it's actually going to happen. No. So XYZ Bank has issue. It may not survive till December 2027. If I tell you what will happen the following day, you'll be shocked. Bank rush. So we want to see impressive compound annual growth, meaning customer confidence is key. People are willing and they are ready to go to the bank to deposit funds every now and then. Once customers begin to pull their funds away from the bank, it will reflect. It's a sign of confidence in that bank. So do not invest in the bank that you have zero confidence or the public doesn't have confidence in. So lower cost of funds is what we follow if people have confidence in the bank. And then the lower cost of fund translates to what we call the higher net interest margin, because once you go to the bank to deposit funds because you have confidence in them, then the banks will use your money to probably do other business. For instance, give out loan and advances to other customers, and then they will generate more return, invest in other assets, and then the return should lead to what I call the higher interest margin. So, which is driven by interest-bearing assets. Interest-bearing assets are those assets that are bearing interest. For example, loan and advances, investment securities. And then while the bank is generating funds from there, the bank is also recording what we call a shocking drop in cost to income, meaning that the cost of operation of that bank are being managed. The bank is optimizing costs. Those processes that are being repeated, the bank is automating them. The bank is leveraging technology and eventually drive efficiency. And then you will see how this number, how the cost income ratio has dropped significantly from the last 4 years, from 2021 down. And that means efficiency is very high. And now that the bank is operating below threshold. And then how that the low price to book value confirms the historic valuations below bank's fair value. So you see that the way the bank is selling for right now, the price is even low compared to what the book value is. So meaning the bank has passed the check 1, check 2, check 3, check 4, and yet the price right now is below what the bank stock should be worth based on book value valuation. Book value valuation here looks at the total assets settling all the bank's liability. That means if the bank is to liquidate its assets and then to sell all the liability, what is it worth right now? It's still cheap. is still cheap based on net asset method of valuation, which is even considered the minimum form of valuation. You consider the bank or the company based on what is what, right? Now, if a company is having issues to sell off its assets and then pay off its liability, what is remaining can meet. Is this still worth more than what investors are buying right now? That is another surprise. That's why I call it a shocking, surprising valuation, because if the bank passes this one, customer confidence is high, lower cost of funds, higher net interest margin, cost of deposit, cost to income is dropping, efficiency is high, managing costs. Why is the bank still cheap at this level? These are the things we are going to look at. Now, to help us analyze this, I have carried out a detailed research. So you will see right here, I have my Google Sheets, which I use to spool the bank financial results. Like I've spooled data from the bank financial statement on the Nigerian Stock Exchange website just to save cost, to save time. Sorry. Now, this bank is FCMB. Now, don't rush to say, oh, FCMB, let me go and buy FCMB. Relax, calm down, learn the information. Whatever I'm going to share here will open your eyes on how to analyze banking stock. Banking stock is not like another stock you will just go and check revenue, less expenses, then profit. Many of you, once a bank releases its financial statements, the next thing you're going to check is the bank gross any interest income, oh, profit before tax. And then, no, even if a bank is growing its profits after tax, if you don't go down to understand these key numbers that I'm about to share with you right now, you'll be missing it. You'll be missing it. Look at the details that we're looking at here. The customer deposit of the bank deposits, customer deposits and bank deposits are different. You might have customers and then the banks, insurance that are also keeping money, maybe microfinance bank. Then that gives us the total deposits. The debt issue, the bank also raise money from debt. We'll look at that. Interest on customer deposits, cost of customer deposits, interest on debt issue, cost of debt issue, loan and advance to customer, investment securities, interest-bearing assets, interest on loan, interest on investment securities, net interest income, interest margin, gross earning, total cost, so that's total operating cost, fees and commission, cost to income, profit before tax, and all that. So let me break all this down. Now, the first thing we want to look at is customer confidence. That's why I'm starting this analysis by looking at the customer confidence, which is customer deposit. If customer deposit in the bank, is not growing, take your money away from that bank, sell that bank stock. So for FCMB, customer deposits has grown by an average of 40% from 2021 into 2024. That's customer deposit itself. I'm not looking at total deposit yet. From 1.5 to 1.9 to 3 trillion, they are all in trillion, please. 3 trillion to 4.2 trillion, and then that gives us an average annual growth of 40%. Bank deposits too is 160 billion, 124 billion, 280 billion, and 830 billion has been grown by 73%. So total deposits with FCMB has grown by an average of 35%, which is very good. 1.7 to 2 trillion to 3.3 trillion to 5 trillion, and so far in 2025, which is trailing 12 months, the bank has grown its deposits to 5.7 trillion, from 1.7 trillion in 2021 to 5.7 trillion. That's an average of 37%, which is quite impressive. Don't forget, customer deposits, customer confidence is very, very important. So FCMB has been growing customer deposit by an average of 40%, and total deposit has grown by 35%. Now, why is this very important? I usually call this deposit my cheap money. Cheap money. Why does bank send marketers to go meet up to targets, to go raise 100 million, 100 billion, whatever? You will find out why. Now, there are two ways the bank raise money. It's either they raise via deposit or they issue debt. Now, look at FCMB debt issue, 159, 173, 269, 553, and 723 billion. So you can see that in 2025, that's trailing 12 months so far, last 4 quarters, the bank has raised 5.7 trillion as total deposits, as well as raised 725 billion as debt issue. So you can see that the bank is largely tilted towards deposit. Why? The answer is very simple. Look at the interest the bank is paying on customer deposits: 38.8, 68, 126, and 25. The interest the bank is paying on customer deposits is sitting at 2.5%. So we call it cost of fund, or cost of customer deposit, or cost of deposit. So it means that FCMB has been paying an average of 2% of its total deposits, 3% of its total deposits, 4% of, and 5%. Although total deposit is growing gradually, 2.5, 3.5, 4.1, and 5.9. Why? Because of CBN increase in interest rate. So you can see how improved increase in interest rates, or the hike in interest rate that we have witnessed in the last 5 years, have also pushed cost of deposits higher. 2%, 3%, 4%, and 5%. Let's now look at the interest on debt issue, meaning if the bank decide to issue debt or imagine a bank relying on debt issue to run its operation, it will run down, because the bank's cost of debt issue is 14%, 11%, 13%, and 16%. So tell me which bank will survive if they had depended on debt issue. So bank cannot and will never survive if they depend on debt issue, because one, their cost of debt issue is quite high: 14%, 11%, 13%, and 16%, when cost of customer deposit is just 2.5, 3.5, 4.1, and 5.9. If you're the one running this business, where do you think most of your money will be coming from? Deposits. So meaning that the bank will do anything and everything to raise money via customer deposits. Sometimes you see them come up with promo to entice you. Oh, we 1 million naira every three days, every 2 days. Customer savers promo, whatever promo. Why? Because your money is your money is cheap for them. When they use your money, they will make more money. They will generate higher return, but they cannot issue debt. How many banks are coming to the market to issue commercial paper regularly? It is rare. Commercial paper is very expensive for the bank. Only a few banks will go that route, but majority of the deposits, they come from customer deposit. Why? Because the cost of customer deposit is very cheap. So imagine 2.5% compared to 14%. When you go to bank A to borrow money and the bank A is charging you 14% for that money, and then you can easily come to your uncle to say, "Uncle, give me," and your uncle is saying, "I will charge you 2% or 1%." Which one will you select? So the bank decides to grow with customer deposit because that is where cheap funds are coming in from this data you're seeing right here. Now, how does the bank use this when they collect these deposits? One, they deploy as loan and advances to customers. You can see right here. And then FCMB has been growing its loan advances by an average of 22.1%, from 1.6 in 2021 to 1.1. So the 1 trillion in 2021 to 1.1, 1.8, 2. You can see here 2.3, and then 2.3. So, and on average, it's been growing its loan and advances to customers by 22%. So that means the bank is tilted towards a loan-driven bank. You know, when you want to understand the business of a bank, don't just say the bank collects loan, collects deposit, and then give out to customer. No, you need to know how does the bank utilize its customer deposits. That will tell you the business of the bank. So majority of the customer deposits are actually deployed as loan and advances to customer. And then you also see investment securities have been growing to 372 billion, 524 billion, and then 794, 1.1 trillion, and 1.5. So Fidelity Bank has also been growing its investment, but you see that the bank is tilted towards loan and advances more than the investment securities. So the investment securities at this point is catching up. So the question is Fidelity Bank going to be a hybrid bank? For me, a hybrid bank is a bank that is tilted towards both loan and advance to customer and investment security. So you can see here 2.3 against 1.5. So I'm watching this particular number at the end of this year, whether it's going to catch up with loan and advance to customer, or if the bank would decide to push more. I will tell you the implication of this. If a bank is invested more in loan and advance to customer, it has its advantage and its advantage. If a bank is tilted more to investment securities, it also has its advantage and its advantage. For loan and advance to customer, here, the advantage here is that the bank is able to generate higher return especially if it's a bank that has gotten it right in its business of lending to customers. That's the reason why I love Fidelity Bank. Fidelity Bank is one bank that has perfected its SME loan to customers. So any bank that can grow its cheap funds via loan and advance to customer, especially banks that can keep its deposit default rates at a lower end, banks that can maintain low default ratio, then that bank has gotten it right. Now, for investment securities, this for me is like a free money because they will invest in treasury bill and bond. The only risk here is that if CBN decide to reduce interest rate like we have seen right now, that will definitely pressure banks' earnings. So a lot of banks that are heavily invested in treasury bill, government bond will also be affected right here. So that's why you need to consider the business of the bank. For a bank that is heavily invested in loan and advances to customer, such banks may not really suffer. You know why? Because when CBN reduces interest rates, yes, the bank is going to cut interest rate, but it will encourage more people to borrow. And when more people are borrowing, what happens is going to support the bank's interest income. This is one of the reasons why I like FCMB, because if the bank has perfected his loan business and customer deposit is growing, then it means that a lower interest will definitely favor them. So when you say lower interest favoring banks, you need to consider the kind of banks that have gotten it right in the loan operation, because that lower interest will be covered, will be offset by increased request for loan since interest rates have been reduced, and that is good for Fidelity Bank and FCMB. I've not looked at other banks, but I'm showing banks that have looked at their data and I'm giving you feedback based on what I saw. So interest-bearing assets are the summation of all the assets that generate interest. For instance, loan advance to customer and investment securities. So that's addition of these two: 1.4, 1.7, 2.6, 3.5, and 3.8. So the bank has been growing its interest-bearing asset by an average of 27%, which is good. Assets that bear interest, if they continue to increase, then it means that interest would also go up. But you need to know the type of risk that that bank is exposed to. Interest rate risk is actually a major problem in 2026. But for me, I think banks that have gotten it right in their loan business may not face, may probably be shielded a little bit. Why? Like I said earlier on, that lower interest will make more customers to request for loan, and that will make up for that tip. Actually, banks that have gotten it right in being able to screen for customers will definitely, but banks that are heavily invested in investment securities will probably face a lot of challenges next year. So don't assume that all banks are going to be the same in 2026. But I'm not saying Fidelity Bank will go up or do well in 2026, but I think this bank has a lot of potential once we are done. Once I'm done with this analysis, you will see why I said so. Now, look at the interest on loan to customers here: 137, 174, 272, 443, and then interest on investment. So these are the interest income earned on loan to customers, as well as interest earned on investment securities. So total net interest. The net interest here is total interest less interest expenses, because as the banks are actually generating more money from loan advance to customer, they are also paying interest. You can see interest on customer deposits. So they are also paying interest. So when you deduct interest income, so interest expenses from interest income, and then factor in impairment charges, then that will give you what we call the net interest income. The net interest income is very important because that's what the bank has. That's what the bank has generated so far from its operation after accounting for interest expenses, which is the interest they pay you on your fixed deposit, your savings deposit, or your current accounts. So net interest income has grown from 90 billion to 121. You can see here 176, 225 to 326. So SMB has been growing its net interest margin by an average interest income, sorry, by an average of 37%. Net interest income by an average of 37.4%, which is not bad. So you can see the numbers here. You can see that the bank has been growing by double digits, 40% growth in customer deposits, 35% growth in total deposits, which is good. Loan advance has been growing by 22%, and then interest-bearing asset has been growing by 27%, and the net interest income has been growing by 37% on average. So this is between 2021 into 2024, 2025. So that's like 4 years. So that's why I said that this is good for people who are considering long-term investments beyond 1 year, 2 years, or 3 years. That means you want to buy the bank stocks, you want to hold them over a period of time, and then irrespective of market volatility, so long as customer confidence is key. So one of the major driver or catalysts behind this growth is customer confidence, because if the bank is not growing customer confidence, every other data you see here will be null and void. How will a bank generate more money to give to customers as loan advances if people are not coming into deposit fund? And how will the bank make more money if it's not able to give out loan advances to customers? How would you think net interest income? So you can see that they are all connected, which is why I said the starting point of every analysis on your banking stock should be customer confidence. Very important. Now we arrived at net margin. What is net margin? Net margin is just like your profit margin in your normal business. Look at your profit margin, which is going to be your net profit over your sales. What percentage of your sales, sorry, for every 1 naira sales generated, how much is the company going to keep as its own money? So here, for every 1 naira deployed as loan and investment securities combined, how much is the bank earning as its own margin? So net interest margin here is your interest income over your interest bearing assets. That's why I added the bank's interest bearing assets, 1.6 plus 2 right here. So 1 trillion plus 372 billion, 1.1 plus 5, 1.8. So your total interest bearing assets, how much are you generating on that money? So that's what we have here. So you can see net interest margin is 6.3, 7.9, 6.7, 6.3, and 8. Now you might look at this money and say, is it 6 point something? No, it's not small, because we're looking at trillion. This is 1.4 trillion, 1.7 trillion. Like I said, they are all in thousand. 2 trillion, 3.5 trillion, and 3.8 trillion. So you can see here that this money is not small. So here's the important information I want to share here. Now, this same money, because this interest-bearing assets you're looking at here, how did the bank get the money? That's the question. Most of the money came from customer deposits, right? Now, on this customer's deposits, how much is the bank going to pay the customer on either savings, current, and fixed deposits? The bank is paying the customer 2.5%. That's what we call the cost of funds. That's what it costs the bank to keep your money for you. Now, how is the bank using this money? The bank is deploying this money to loan and advances and investment securities. And how much is bank generating on this same money that they collected from you? The bank is generating 6.3%. So if the bank pays you 2.5, and then the bank is able to make 6.3, and it's giving the bank a spread of 3 point something to 4, then that is good. Like in 2022, the bank paid 3.5% as interest on our deposits, and then the bank made 7% on that money. Don't forget, it's in trillion. Now, the bank made 4 points, the bank paid, sorry, please, 4% on customer deposits, and the bank generated 6.7. And then you see here 5.2 and 6.2. So that means you need to pay a lot of attention to what the bank is paying on customer deposit, as well as what it is generating for itself. Now imagine that it is a bank that is look at here, that is dependent on debt. So tell me, how can a bank survive if it's paying 14.3% on total debt issue and is generating just 6.3%? Meaning, if it collects this money as debt and it deploys it, it's going to make 6.3%. That's a loss. You can see 14% paid as interest, and then here 11% paid as interest on debt, and then is now generating 7%. 13% paid as debt, 6%. 16% paid as debt. And now the bank is generating 6. Do you think the bank will survive? The bank would have closed shop. So no bank can survive if they are fully or largely funded by debt issues. So this is the reason your bank is pursuing your money. This is the reason your bank wants your deposit, because that's the only way they can survive. Because on your deposit, they pay you 5.9%, and on that money, they're going to earn 6%. Now, the difference is also what we call the spread. And they look at FCMB so far in 2025, net interest margin is 8.37. So once they release their full year for 2025, this is trailing 12 months. I'm adding the last 4 quarters. But once they release their full result for the year, we'll be able to check all this number and then tell you what I think about the bank. But so far, so good. This is not bad. Now, total gross income of that bank, meaning both the net interest income and the non-interest income, the interest income and the non-interest income. Here, every other income sources, including fees and commission. Fees and commission here is coming from ATM charges, bank transfers, and all that. The bank has been growing its fees and commissions by 53% in the last 4 years. Now, look at what is very important for me here. This is the gross earning of that bank. And this is the operating costs. You can see the operating cost of the bank: 111 billion, 138 billion, 216 billion, 217, and 319. Now, the bank operating cost has been growing by an average of 29% because of inflation. Inflationary threat is actually making the bank to spend more. But you don't look at that and say, oh, the money is too much. Let's compare what portion of the bank net interest income is it using to pay or finance this cost that is rising. So that's what we call the cost income ratio. You're looking at the percentage of that particular revenue or gross earning that it is using to finance, and to tell you whether it is good or not. So that's what we call the cost to income ratio. So out of 212, 52% of that income went to operating costs, which is above standard, because a bank's cost to income should be below 40%. 40% is very okay. Now, in 2022, you can see it dropped to 49%. Out of 282, 49%. In 2023, it dropped to 41%. And then in 2024, it dropped to 34%. And so far in 2025, cost to income is 32%. Now, can you see how the bank has been lowering its cost to income? This is what we call efficiency. The bank is driving efficiency from 52 to 49 to 31 to 34 to 32. That's how the bank. So this is a sign that the bank is optimizing costs. The bank is optimal. The bank is deliberate. For example, there are some repeated processes that can easily be automated that automatically save cost. Save cost means you don't need anybody in that department again, because AI is doing the job. Technology is doing the job. The advent of ATM alone, a lot of banking staff lost their job. So there are things ATM can do. For example, then if you want to withdraw, you can go to the banking hall to withdraw. You will see queue, but now ATM is taking care of that. So that's what we call cost optimization, being able to automate some processes, then achieve higher results. So this for me is a major line item. It's a major, and then look at how the bank is growing its gross earning. It's been growing gross earning by an average of 46% in the last 4 years, while growing the total profit of cost by 29%. So that means gross earning is even growing faster than operating costs. So no wonder you see finance cost to income ratio drop significantly. This is very good for Fidelity Bank. And then profit before tax has been growing by 53%. Profit after tax has been growing by 42% on average. Now, you will notice we had a dip from 93 down to 73 right here. That's in 2024 because of the windfall tax that we saw. So that's why you see a dip. And then you see trailing 12 month already is above the previous full year, 87.2 billion and then 73 billion, meaning the bank is on track to beating its previous full year financial. So profit after tax has been growing by 42%. Look at EPS, the same thing. EPS, the same thing too. We saw a drop in EPS because of the windfall tax, but hopefully we should see a recovery. But then the public offer that we're looking at now can also dilute earnings further. So that's why I said this banking stock is good for long-term investment, meaning by the time they raise their capital, they meet their capitalization deadline figure, then we should see the bank come back. And this one bank that will rise so fast. That's why I am very, very concerned. I'm sorry, I'm not concerned in terms of the negative side. I'm concerned because I was wondering why the investors have probably underrated this bank, why they have allowed this bank to stay at this 9 to 10 naira level for a long time when it has this hidden potential. Now, look at the return on equity of the bank. Return on equity has grown from 8% to 11%. 8% to 11%. And then you see the shareholders' equity. Now, look at the most important part of this analysis. Now, the shareholders' equity of the bank divided by the ordinary share gave me a book value. Book value. FCMB book value was 12 naira 24 kobo in 2021, and the bank was selling for 2 naira, meaning in 2021, the bank was 309% undervalued. And then in 2022, book value was 13.83, and the bank was selling for 3 naira 85 kobo. The bank was 258% undervalued. In 2023, sorry, FCMB had 23.38 book naira per share book value, and the bank share was selling for 7.4. And then in 2024, book value was 23.1, and then per share price is 9.7. And then so far in 2025, book value is sitting at 19.68, and then SMB is selling for 10 naira. You can see the increase from 2021, 2.9, 3.8, 7.4, 9.4 to 10.7. Look at the increase, year-on-year increase in share price. Now, you also notice that the valuation here has been dropping 309 to 259 to 215, down to 144, down to 83, meaning that FCMB stock price is closing out, is catching up with its book value very soon. That's what it means. So this already shows that the banking stock is on its way to catch up with its book value. That's why you see that the rate at which the banking stock is undervalued compared to its book value has been dropping from 309 in 2021 down to 83. You can see year on year, 259, 215, 145 down to 83. So meaning FCMB is actually, or we catch up with the fair value very soon, book value very soon. And if it has to catch up with book value, then it means that the share price should top at least 19 naira. So that's like 90% from today's price of 10 naira. Now, this may not happen next year, 2 months or 3 months. It means if you are holding the stock over a 4 to 5 year period, then Fidelity Bank FCMB might actually catch up with its bank book value of 19 naira because it's closing out. And don't forget, my first analysis was customer confidence. So if FCMB customer confidence continue to grow at this pace from 5.7 trillion, then in 2026, it grows into 6.5 trillion, 7 trillion, 8 trillion, then it automatically means that the bank is going to raise more money to push its interest-bearing asset, because the more this deposit grows, then the more the interest-bearing asset grows. And the more interest-bearing asset grows, the more net interest margin grows. And the more net interest margin grows, then while also optimizing costs, then it means that the bank will be able to catch up with its fair value very, very soon. This is how to analyze banking stock. This is not a job. This is not something you do overnight, 2 minutes, 3 minutes, and say, oh, I want to invest in banking stocks. Some of you want to invest huge money in banking stocks, and you don't want to pay someone to carry out detailed analysis like this. You just want a quick job. Some of you will come to YouTube and say your video is long. You are not serious. You are not serious. I'm sorry to say. Go and keep your money elsewhere. Go and put your money in savings deposits. If you are serious about investing in Nigerian stock market, investing in the banking stock, this is what you should do. So that when you put your money there, you'll be able to sleep well at night. This is the due diligence that I'm talking about. There are people in my community that are deep pocket investors because of the volume of the amount of money they want to put in that bank stock. They can't afford not to watch my video because in my video, I carry out due and detailed analysis. That was exactly what I did on Fidelity Bank. So when you want to invest your money in a bank, especially a bank you're looking to hold over a 4 to 5 year period, then this is the kind of analysis you carry out to improve. So when you go back to your drawing board or when anything happens in the market and you go back to your drawing board, the first thing you want to check is, are customer deposits still growing? The moment customer deposits stop growing, it's time to put your money out of that banking stock. It's as simple as that, because the bulk of the money they generate to run their operation is deposits. And why? Cheap money. Look at cheap money. The bank cannot survive on debt. They will run down. Cost of debt is already higher than net interest margin. So how do you expect the bank to be raising money? That's why you see banks hardly come to the market to sell commercial paper to us or corporate bonds, because it's expensive. The best place, the best sort of fund for any bank is deposits. That's why they are willing to pay marketers. That's why they are willing to send marketers to anywhere just to make sure that they get the money. And they reward them handsomely too. You see, one of the top marketers of a bank, they are even telling the to be most bank manager, they are top marketers because they generate a lot of money for the banks. So, what are our big takeaway from this analysis that I just shared right here? This is my takeaway. So, pay attention to this particular takeaway from. So, the big takeaway here is that banks that enjoy growing customer confidence will remain solid and good for long-term investments. So, if you are considering investing in a bank for long term, this is the first thing you should look at: customer confidence. Because nothing ruins a bank faster than bank rush. When customers are rushing to withdraw their money from a bank at the same time because of bad news. So any bank that is going to be a hold for you for long term, customer confidence, as explained here, total deposit must be growing. Very key. Like you can see from Fidelity, total deposit 35%, customer itself, deposit itself 40%. Second take, banks that are able to deploy cheap funds and generate higher return from lending to customers remain a solid buy. Banks that are able to deploy cheap fund. What is cheap fund? Total deposits. Look at why it is cheap. Interest is cheap. 2.5, 3.5, 4%, and 5. And then when they deploy it to generate higher return, where's the higher return? 6%, 7%, 6.7, 6.35, and 8.3. Expensive funds are debt. This is expensive. No bank can survive on this. Don't even go close to this. Any bank that has most of its funds coming from debt, don't even go to that bank. Pressure. There's pressure. So cheap funds, very key. Banks that are able to automate repeated processes to save time, optimize cost, and leverage latest technology for service delivery are a must own. When a bank is automating its processes, when a bank is optimizing cost, it will be very, very visible right here. Cost to income ratio. It will be very visible. Look at how FCMB had optimized cost. Look at how they have dropped their cost income ratio from 52% down to 32% over a 4 year period. This is massive. This is very impressive, meaning that the more they grow their income, don't forget costs are being optimized. And then look at the rates at which operating cost is growing versus income. Operating cost has grown by 29% on average from 2021 down to 2024 and 2025, 2012 months. And gross earning is growing by 46% on average. So cost to income ratio, look at the drop. Look at it here. Look at it here. This is a bank that is deliberately optimizing costs just to reward shareholders, to deliver value. So that means FCMB is highly efficient right here. If a banking stock or if a bank is able to meet these three major criteria, there is no reason why you shouldn't hold that bank for long-term investing. It's as simple as that. There's no reason why you shouldn't hold that bank for long-term investing. And if I come here to look at the chart of FCMB, the long-term chart of FCMB. Now, FCMB is selling for 10 naira at this point. Now, you notice something here. Look at how the bank has tested 12 naira right from 2024. First test, second test, and third test. So this is a major wall right here. If the bank is able to break out of this may not happen, like I said, it may not happen tomorrow, it may not happen next year. But if this happens, based on the growth I have seen on their financials using this metric, if it happens, then FCMB might break out into 19, 20 naira because this is 12 naira key level. So if you break out, nothing is stopping FCMB, sorry, from touching 19 to 20 naira, and that's aligned with my estimated book value of 19 naira right here. So meaning that the bank, if you break out of 11 to 12 naira, to touch 19 to 20 naira, which is the average book value of that bank based on the current financials. This is what I do when I analyze banking stocks. I don't do this regularly. This is the kind of analysis I carry out whenever I want to invest in a banking stock for a long time. If you are considering investing in a banking stock for a long time, if you are looking for a bank to buy, you have a bank in mind and you're not sure if this bank pass your checklist and all that, we can have one-on-one. I'm open to one-on-one section, but it's a paid section. It's a paid one-on-one section that I have with selected investors who wants to invest in the bank and are considering a detailed analysis like this. You can come to me, come to my DM, come to my support. Let's talk. I charge for it. I'm not cheap, but the value I provide at the end of my analysis is worth it. If this video makes a lot of sense to you, kindly hit the subscription button and turn on the notification bell so that when I release timely video like this, you'll be among the first to get notified. And if you want to join Glufolio, kindly go to glufolio.com/subscribe, pick a subscription that works for you, and I will see you in the community. Thank you.